Hey everyone, this is Adi again. I just wanted to take you through the Greeks document, the Greeks that I look at, and my pre-trade checklist. This thing has worked for me for years. I've been trading short options for almost 10 years now. These set of tools, meaning the Greeks that I look at, or I will show you right now, and the pre-trade checklist has worked for me. Everybody's different. Something else will work for you better. This is just my guide out there. This is what has worked for me, and I just wanted to put out there to show how it goes. And then we will go through a real trading example of S&P 500. I just want to show you a credit spread that we're looking at that looks interesting to me right now. I'm thinking about putting in my real trading account, but here's the problem with these credit spreads in S&Ps or any of the major index recently. It doesn't really give you an option. I was trying to sell one yesterday when the markets were down. The markets are so bullish. So, as soon as I start picking up the strikes and start setting it up, the market has already moved up on me. So I don't get the right price. I don't get my price. The market has already gone up. It's so bullish. Every downtick, every drop in the market has been bid up. The buy the dip thing is like long, it's alive right now, very much. So it doesn't really get that opportunity in the index, on the indices. But if you look at the commodities market, those are calmer right now. They are much more calmer. They do have some volatility, not much. Like the currencies market, not much, but there is something to do there. But the idea here is to like go through the Greeks, like what do I look at? Anyway, this document, and I'll put a link out there in the video for this document. It's available on my website on this link. Just enter your email address and get it. Maybe it will be helpful for you, maybe not. But so okay, let's go through this. Table of contents, you can go through it in your own time. I don't need to go through every single thing here, but most of it, let's just try and cover all the main points or main contents here. So delta, what is it? Price change in option price per $1 change in price of underlying. Meaning if the underlying goes up $1, the delta will move up $1 for a long call. This second part here is the most important thing. Print it out and put it on your desk wherever you trade. Just put it out there because this is the most helpful thing that has happened to me. It's easy to look at, whatever the Greeks are for long call, short call, long put, and a short put. The main thing that you need to remember is for long calls and long puts, where you are paying a debit to get in, your theta is always negative. Your delta is positive for long calls, negative for long puts, and you are always long volatility. These are the three main things that you need to look at. Don't worry about roll. I don't even look at it. It's just there because it covers the 5 Greeks in this space. But those are the three main things: delta, theta, and vega. Don't even look at gamma. Gamma is the second derivative here. It calculates the rate of change in delta. So that's the second part here in gamma. This is what gamma does. It calculates the rate of change in delta, like how fast the delta is changing. Now, when you are very close to expiration, the gamma will move your delta a lot, meaning the gamma balloons up closer to expiration. Further out in expiration you are, the calmer the gamma part is. And if gamma is calm, then your delta position is also calm. It's really calm. So you don't want to be really close to expiration when you're selling options. Now, you must have noticed I don't talk about buying options because I never buy options. There's only a 30% chance to make money when you buy options versus when you sell. There's nothing that you cannot do on the sell side of these of options that you can do on the buy side. Meaning, if you are trying to be bullish on the market, you can be bullish with higher probability of success by selling an option, by selling a put spread, doing a couple other different things. A huge strangle, a butterfly spread, a diagonal spread, whatever, a short straddle. So anyway, no buying options, only selling options here. Theta is positive for sellers. This is the biggest killer of long options. Meaning, if I buy a call or a put, I am always negative theta. Meaning, every single day I'm losing money. The option will decay every single day, especially in the last 15 days. It will decay faster, or 15, 20 times faster than the first 20 days. That's the mechanics behind it. The theta. This is how these derivatives are actually designed as a function of time. That's one input, a big input. And then the Vega part, meaning how volatility impacts price of options. For sellers, you're always short vol. You make money when the volatility drops. And the idea to sell short options is because whenever volatility goes up, let me show you a chart of VIX, and this may convince you to move from buying options to sell options. I cannot emphasize enough for people who are buying options. Yes, I know it's an easy thing to do. You can only lose maximum of your debit paid, but you always lose that. 70% of the time, 80% of the time, you always lose your debit. Here, you don't lose. You have a higher probability. Whatever probability of a long holder is, yours is the other side of it. So if the long holder has only a 20%, 30% chance of making money, if you are selling that option, you have a 70% chance of making money, right? So you collect small amounts, you manage the trades, you massage the trades, you massage the, whatever you want to call it. You stay in those cycles, you stay calm, you stay patient, and you make money when the market is in panic. And trust me, when you learn this skill, you will never go back to like buying options. You will always sell an option to do anything that you want. Bullishness, bearishness, if you want to go bull, long the market, short the market, neutral market, whatever you want to do, you will always be on the short side of the premium. You would like to sell the premium. Anyway, it's a journey. It takes time to learn this, practice this, and perfect it. But here's the idea. That's what I'm trying to do. I'm trying to show you my journey, it took me to get from buying options, losing money all the time, to now selling options, making consistent income day over day, year over year. It's been a couple of years now, 3 or 4 or 5 years now that I've not lost. I've not had a negative year. Yes, I sometimes don't beat the market. The market goes up crazy, like 25%. My account does not go up 25%. It goes up 15%. But it goes up 15% 9 out of 10 times, right? 9 out of 10 years. Whereas SPX or S&P 500 will go 25, then down, then up, then on average it goes up 10%. If you do real return on that SPX, that's even less. So from 10%, take out all the inflation pieces, and you're left with like 7, 8, 9%, not even 9, 7, 8% max. So there are two options. Either you go and buy these index funds and stay in S&P 500 for the whole year, or you become an active trader, which does not take that much time. Once you perfect this art, you have to spend some time on it, like learning any other skill. You have to spend the time. You've got to do the work to understand the concepts and stay engaged in the markets. Anyway, here's one lesson on the Greeks. The most important thing in options trading. Let's go into VIX and then just look at the chart. You will look at the VIX chart here and see the VIX, the volatility, whenever it goes up, comes down every single time. Look at how calm or easy this chart is to look at. It does not go, it doesn't move zigzag like that for like how an index chart would work or any stock chart would work. Now, what does this show us? This shows that volatility is a mean reverting asset. It spikes up and it comes down. Think about all these big institutions like with billions of dollars, all these endowments, all these hedge funds. Well, not hedge funds, but all these big institutions who hold a lot of client asset, and they want to put this money to work somewhere. They don't put in on the short side of the market. These are buyers of the market, meaning 70 to 80% of the time, this money drops on the market to go look for assets and buy these assets. And that's why you see the VIX chart is very mellow. The average is like 16 or 17 or even less last 10 years. This is a 1 year chart, but you go back 10 years, you'll see the same thing. That all these big institutions, what they understand is they don't want to be in risky positions because these are client assets. So they will go out and buy the market, buy assets, pick up stock, pick up financial assets, pick up this, pick up that. When they do that, the market stays up, meaning the volatility stays down and the market stays up. Now, so how is that good for us? Well, it's good for us because when the market is down, we have strategies up our sleeves that will still sell premium and collect, and stay with the market. This is the best part for option sellers, but here also, as well as here, This is a really good part too. Like there are earnings trades which pumps up volatility in the market. There is crude oil market volatility. There is interest rates. There is Fed announcements. There is a multiple a, a list longer than a door of things that you can do when the volatility jumps up. A lot of things. So just wanted to give you some perspective on why we sell options. Here, this is why we sell premium. We sell volatility. When it comes up, we sell it down. Anyway, let's go through. I just did not want to waste your time, so I have given you some guideline here on why you should invest some time in reading this document. If you don't like it, obviously throw it out of the window. But I think you will. This will benefit you. This will benefit your trading because it has benefited me. I was a pure option buyer back in the day, but I don't do that anymore. Anyway, you can read this whole thing. Why do options Greek matter? Obviously, they matter because those are the Greeks or those are the inputs that affect option prices. And as option sellers, you need to know how your options are getting affected. The whole price is moving or changing so that you can go out and adjust it. Okay, let's get to the groove of it now. We've seen it measures $1 move change in the option price when the underlying moves. Why does it matter? That's the more important part. Because it's the probability of success. Now, what I'm trying to say here is this: go into a Apple position. Let's pick up Apple. Uh, let's pick up in the cycle. Let's pick up a at the money. Oh well, I do have a short position which I put on while doing another video. Still there. Forgot about taking it off, but I will. Let's pick a call side. 240 strike. I'm buying a. And by the way, when you buy an option, you have to hit the ask price. This is the ask side, which is the offer side, which means this is what people are offering for this asset, meaning for this option. This is what they're offering it at. When you sell it, you hit the bid. Okay, just remember that. But yes, I'm taking the offer because I'm the buyer of the asset here. Let's go down one. And I've already forgotten what I'm trying to show you. It's the delta piece, right? So take out the short put here. Let's go through delta. What is my probability of profit? That's what we're looking at. I need to stop straying, sideways in my videos. Just stay focused on the topic. But anyway, sometimes I have a lot of things to say about things and topics, and therefore, I wasn't supposed to start this video by talking about the markets and like option selling and all that, but that's how it goes. Where is it? Okay, you have to set your slices here. Break even 322. Okay, I'm set up as 322. That's good. So what is my probability of making money in this? And that is, if you look at all the probabilities here, 39 plus 11, that's 50%. Only 50% chance because I picked up that 50 delta call option. That's a 50% chance. If I have picked up a 20 delta option, I would have only had a 20% chance of making money. Meaning, who else will make money here? Who else is part of this trade which will make money? If you only have a probability of making the money here, a very small probability of making money here, which is 20%, who has the other side of it? The option seller has the other side of it, and that's why we sell options, because we pick up small trades. I get it. It's completely fine. It will take some time to build up the account, but you will build it up more often. You will lose less and you will gain more. Whereas if you just go out and buy, this is a 50-50 shot. You may not even, you may not make money here, or you may make money here and you will lose in the next 5 trades. Probabilities are not on your side when you buy options. So yeah, this is how the delta looks. Now let's look at other Greeks here. When you pick up a long call, you're negative theta. I've already shown you that. You pick up some delta, which is 64 here. It must have changed. Yeah, the price has changed, so the delta has changed. You pick up long call. Now where am I looking at? I'm looking at this. Looking at this row here. So you are delta. You pick up small gamma. Now if you pick up something which is very close to expiration, this thing would balloon up. This will be a very big thing. Theta is negative. You will lose $10.80 every single day on this option. By the way, that's what it means. You will make money if volatility goes up 1% overnight. You will make money. You will make $28, and that's it. That's what we look at. So that's what delta does for you. So what should we do? A call option of the delta of 30 means option will increase by 30 cents for every $1 move. Fine, we know that. A put option delta 40 will increase by 40 cents. That is true. We also know that. How do you use it on the option selling side? Like I said, my sweet spot is between 17 and 20 delta. You should sell the hell out of it until your hands bleed. So, if you were bullish on the market and you wanted to collect that much delta, I would go out and sell this thing, which I've already done in Apple. In my previous video, I sold a short put. That's where it is. Look at the probabilities on top. They're all in my favor. I have an over 82% probability of this thing going in the, making money for me. Not going in the money. Going in the money means you are losing money, but making money for me. 82% chance. Buying an option was, how much was it? Maybe 50, 50% because we picked up a 50 delta call. So this is what you can do in the market. How fast delta changes. This is what gamma does for you. Like I said, gamma is small for further out in expiration. It's big for very close to expiration. And you should always avoid being very, very close to expiration and always, adjust your delta or adjust your gamma. Well, when you adjust your delta, you adjust your gamma automatically anyway. That's what's called gamma scalping. This is what, when you adjust rates, that's what gamma scalping is. If you think these big banks are like doing something different, this is exactly what they're doing. Traders sitting at Goldman Sachs and JP Morgan and their trading desks, what they are doing is they're selling these calls to the clients. Because clients come to them to facilitate these trades. Meaning, if somebody wants to take an exposure in the, let's say, an emerging market stock, they'll come to JP Morgan desk and be like, can you quote me on this? And that guy will just charge some commissions on it and be like, okay, here's a quote. This is what we will sell it at. Once done, the JP trader now needs to hedge the risk. So for short call, if he has sold the call, he needs to go out and buy the stock. So that's how because option delta is dynamic. It changes, it moves. So you cannot hedge a dynamic asset with a dynamic asset. You have to have a static delta to hedge it. So a short call is then hedged with long stock. And I talk about this in my other video, and I will make a video out of this as well. You have to have static delta to hedge your dynamic delta. And your short call option, meaning now you are short call and short delta, you need long delta, meaning you need to have something positive coming into your portfolio to hedge it. And that positive delta comes in from a long position is in the underlying stock or a beta weighted stock. If he cannot get hold of a 1-for-1 stock position, they will go out and go cross hedging, meaning they will go out and buy something that moves similar to that underlying asset, or beta weight this hedging, meaning if they don't want to hedge all the delta completely, they will beta weight it to something that moves similar to this asset, and then buy that asset. Static though. Futures are static. Swaps are static. What else is static delta? Obviously, these option derivatives are all dynamic delta. There are a couple other things like forwards are all static. Futures I already told you. Non-deliverable forwards, same thing, static delta. So you can go out and buy that. The next thing I wanted to show you is how to use it as an option seller. I said avoid short-term options. Don't do this. Gamma is highest near expiration. Make price swings extreme. So don't do that, please. Use credit spreads to manage gamma risk. Yes, that's another way of doing it. Don't go naked options. Go credit spreads. Okay, Theta. I need to take you through my checklist as well. So I need to run through this very quick now. Measures how much an option loses in value each day due to time decay. I've already shown you that. For a long call, it's negative. For a short call, the whole thing is positive. Meaning all else being equal, the position decays $5 per day. We know that. Fine. Get going. So sell options 30 to 45 days out. That's what I've written here. That's my sweet spot. 30 to 45 days, 17 to 18 delta. You can even probably go 19 sometimes, but 17 is what I've noticed is like a sweet spot. If it's available. If not, go 1 or 2 up and down here and there. Don't go too close to expiration. Yes, zero DTs is like a thing of, it's like the biggest explosion that's happened in the options world recently. But again, you'll see a lot of these traders lose money soon, and then the whole thing will just die down. Okay, let's wrap it up. Vega, as I've mentioned, Vega is the volatility piece. That's what we look at. That's what our edge is in option selling. We short the volatility piece, and the other Greeks or delta or direction just depends on our view on the market. If we think that the market is going to be bullish, we will sell a put spread, but short volatility. And if we think the market is going to be bearish, then we sell a short call spread. Now here again, sweet spot is um, sell 30 to 45 days out. Do not sell close to expiration, and just you have to. It's a patient. It's a very long game. Option selling. You have to be very patient. You should. It's like watching paint dry. Yes, that's what it is, but it makes you money, right? It's not like long calls, not like short term long calls, short dated long calls, long puts, which will move either in your favor or against you very, very quickly in a short space of time. This thing, sometimes nothing happens for the first 10 days of the trade. But in the next 10 days of the trade, you will collect your profit and you will move on. That's what happened to me most of the time last year. It's like watching paint dry. Nothing will happen for the 10, 12 days. So that's the kind of expectation I want you to set up here when you do this kind of thing. When you do make your mind up to sell options, be willing to sit down and watch the markets and watch your walls and you watch your, just like, watching paint dry. But stay engaged in the market. There's a lot of things happening. Read the news, watch, you know, interviews and stuff to stay aware of what's going on. In terms of your positions, if one position doesn't come in for the first 10 days, the second one will. The idea is to like spend a small amount of portfolio towards these things and build it up from there. And that's the whole goal. Row, I'm not even interested, but it's just there. It's the interest rate effect on options. It does affect it a little bit, but we will talk about that later. Here, there's a more important thing coming up. So what did I do? I'll put a real trade example in there, but let's go through the example on the platform. It'll be easier for people to see how to actually do this thing. Let's select crude oil market. It's one of my favorite ones. It's a nice market to like trade. Very, very liquid and very supply demand driven. And I feel like there's a floor in this market and then there's a cap on this market. Well, cap, you can argue that it can go either way, but there is definitely a floor. They don't let the market go below a certain point. That's what I think. Below 64, below 63, below 62, whatever. Because if they do, if that happens, a lot of businesses go out of business. A lot of these exploration companies go out of business. There are a lot of small cap companies working in Texas, West Texas, to like pump this oil out. It's not just Chevrons and Exxons, of this world. There's a lot of smaller companies too. So they will all go out of, and they do. A lot of times they do go out of business when it drops. But I think the floor is around 64, 63, depending on how the supply and demand is in the market. Anyway, let's go through a quick example here. The next one is 61 days. That's a little bit too much for me, but let's just do that. So the market is down. Let's look at a chart here of CL. It's down, right? Its high was like $80 in January. So it has dropped from 80 to like 70 now, dropped 10 points, $10. The futures of this market works tick by tick, like $10 a tick. Each tick is like $10, so it's easy to understand. Whereas other future markets are different, and I will have to make a video on that to explain. But anyway, this is an easy one to deal with. This one and gold. Gold is also the same thing. Each tick is $10. So every time a market moves up or down, it will move $10 in your P&L. Fine. Okay, let's trade this. Volatility is on the low side here because it's been very calm recently. Look, it's been very sideways. So I did have a put spread, short put spread here, I think, and then I took it off when it went up to 73. I only made like 40% on that trade, and after commissions it was maybe 30, 35, but at least something, when volatility is so low, look where vol is. It's on the bottom of it, bottom of the chart, right? When it's that low, I don't like to stay in trades for too long. Just get in, get out. Even 40%, I'm fine. Anyway, let's do a trade example here. So short put spread. I hope I don't take too much of your time here. But look, full strikes. Now also look at one more thing here. I don't go for half strikes because the open interest is not there. Look, there's one contract open. Two contracts traded versus 1,400 contracts or 135 contracts in this strike, 63 strike. So that's the one that I'm going to trade, the full strike. So sell a vertical, change this to one contract, or do it whatever your account allows you to do. I normally go out in the crude oil market. I normally go out one whole strike, no more, because that's what my risk limit is. And I'll try and collect. If I was doing it as my real account, I'll try and collect 12 or 13 ticks on here. But because we're trying to fill it, I'm going to take it to the Analyze tab, show you what all the numbers are, and then I'll just put the trade in. Let's see if it fills. Oh, it's really slow. My screen is still stuck on. There you go. It was stuck on that Apple stock for a while. So let's take it out. Let's look at all the numbers. First of all, set your slices. Set slices to break even. 417. The top part is 417. Now here, the probability of coverage is 87. Now because it's a pivot trading account, I don't believe that number. This number should be around 82-ish. Because we're selling, think about it, right? We're selling 17, 18 delta. Well, actually, we're selling 16 delta, right? So they could be true. But usually, this number comes up to about maybe 80 to 83%, which is still good enough, right, for me. I like the number 8 in front of that. So max profit is $110. So 11 ticks, you're collecting 11 ticks. Each tick is $10. So 11 times 10 is your max profit. Your max loss is $890 because the overall trade is $1,000. But obviously, we never go up to like max loss. We manage the trade when it goes down by 30, 40% in the P&L. Not even 30, 40. 100% down on the credit collected. That's when I start getting worried about the trade. That's when I start thinking about the management. Meaning, if this trade was trading at, I sold it for 11 ticks. If this thing was trading at 100 or 15 ticks or 16 ticks, I'm down $60 on this or something, or $70, $80. Then I'll start thinking about the adjustment. Otherwise, I will not touch it. It's fine. If the market goes down, it comes back up again. Max profit 110. I'm trying to put it in. So I've showed you. You've seen the. Let's just look at the Greeks as well. Delta of $23. You can collect 23 if everything goes in your favor. Gamma is negative. Theta is positive. You're collecting positive 110 because you have a short put spread. You're collecting positive delta. This will be negative delta for a short call spread. Remember that, right? Theta is always positive for you. You're collecting 110 every day. Volatility is negative. And that's it. The other things I look at. Liquidity side, I've already shown you. Open interest versus volume. This is the amount of money you're putting down. Only $230 to make 105 minus another 450. So to make $100 max, you're putting down 230. That's a good return. Even if you end up collecting $60 on this trade out after all expenses, after all trading, that's 60 divided by 230, right? That's a good return. Now, remember, you can annualize this number, meaning you can do this trade 7-8 more times in this year or even more. So if you collect 60 net of all expenses and you put down 230, which is supposed to change. Now, don't get me wrong, this buying power effect, this will change. This is spend margining, so it is dependent on a lot of different factors. But let's say your average buying power would be $300, right? So that's a return of 20%. Now, if you do this trade, multiple times a year, the annualized return or the full year return could be a lot higher. So look at it that way, that you're collecting 20% on each trade. If you get better and better and better, right? You will collect more and more money. So you will make 60 here, 20% here, 30% the next one, 40%. You will average out all the trades. Annualized, you will make a good number. About maybe my target is between 20 and 30% annualized. That's it. So let's put this trade in. And looks like it will fill pretty easily. There you go. It's filled. So I'm just going to leave it there. Let's see how this goes. So when I was creating the document, I did it on the S&P 500 because at that point the market was down. I liked the idea of selling a put spread there, but within a few minutes, everything just recovered. So I did not do that trade. I tried to get filled, but it just didn't work for me. So anyway, on that trade, these are what my deltas on my Greeks look like. I picked up a 20 delta strike, 80% probability of profit. Gamma was very low. My theta was $6 per day. Vega, okay, this is a negative sign. It shouldn't be there. This needs to change. This is a positive theta trade. Vega was negative 25. Rho was negligible. Anyway, this is how the screen looked on 212. That's when I was trying to do it. What, 2 days ago? It moved up. It opened. ES features opened 60 points down. Great opportunity to sell something. IV was up. Everything was looking good. By the time I finished setting everything up and I put everything in, it already moved up 30 points, 20 points, I think maybe even 40 points. By the end of the day, it was up. So there's no point going into that trade when the market is already recovered. So I would not force a trade like that. I wanted it on my price. So I was trying to collect $150 on that trade, but it just did not work out. But there's everything in there on why and how I did it. So pick up this document, see if it works for you. Take a look, see what you can learn. It's all about learning, Pre-trade checklist. Let's go through this very, very quick. I know the video is already long now, but implied volatility, I've already shown you, like that is what that matters. It has to be over 30%. Definitely needs to be over 20, 25% for you to do anything in any market. Extreme levels, that's what I look at. So if the market is down, I've told you as a contrarian, I will sell puts. The markets have to be at their extremes. This crude oil market, the reason I like it right now is because it's going towards its extreme. Extreme is low of the year is like 65. It's going towards that. As long as I can avoid 65 and go below, I will sell a put spread there. That's how I look at it. Underlying is liquid. Yes, I've shown you volume and open interest. Always look at those two columns. Bring it in your main watch list. Volume and open interest, they have to be in thousands like this. So always select a monthly cycle. Do not select a weekly or a daily. For longer term trades, for consistent income, you have to be in the monthlies. Obviously, in the money calls does not have any volume. It doesn't. That's how the world works. If you look down, go into in the money puts, you won't see much volume there either. There's a little bit more than call side, but out of the money calls has all the volume. Out of the money puts has all the volume. Thousands of strikes. So that's what we look at. Risk reward, again, I've told you. So risk reward has to be better than 1 to 3. Meaning, what does that mean? I am putting down $900 and I am collecting $300. That's 1 to 3. Now, what did we do here? We put down $230 and we collected 110. That's better than 1 to 3. That's almost 2 to 3, right? So you're collecting half of what you're putting down. So that's really good. But it has to be better than 1 to 3. That's how I look at it. That will give you a probability of success of over 70%. Look for highly correlated positions. That's another one of the big ones. How do you do that? In TOS, there's something called in the monitor tab. Go in and do a beta weighting of SPY. I normally look at that, put it at SPY. So now this will give me, my columns are not set up here, but this should give me all my delta, my theta, weighted against SPY, the main market index, right? So that's what you want to do. You want to benchmark yourself against a major index. Market index is S&P 500. So now, if you want to see the difference, take this out and see. Without the SPY weighting, you are up 22 delta, but with SPY beta weighting, you are up only 2 delta. So this is how much your account should move if something moves in the SPY, and if that's how you benchmark yourself. So keep that in mind. I normally benchmark against SPY, which is same as benchmarking against SPX. How much should I allocate? I've already told you, 2 to 3% max. 3 to 4 can be your absolute max, no more, of your account. Print this thing off, put it on your desk, look at it, read about it. Get it from here if you want it. If you still think it's valuable, get it from here. Read through it, and then I'll see you in the next video. Thank you very much.